Excited to have this video today. I got my good friend John Reed back. It's been a while since we made a video, but I thought this would be a great time to have you on, John, because interest rates have changed since the last time we did a video. And you are my go-to for everything premium finance. And I thought, what a great time to have an expert on to talk about what's happening with premium finance and what people who have done financing in the past need to know about what's happening. So, John, thanks for coming on, man. I appreciate it.
Yeah, it's exciting to be here. It's
Yeah.
been fun. The interest rates have done a little bit of a roller coaster, and so I think we're in a different place we were a year ago, and there's some lessons certainly learned from the past. It's an exciting time to be in this space.
That's good. I'm excited to hear that. So, John, for people who don't know what premium finance is, can you give a little background as to like your expertise in it and really where you're helping families and higher net worth individuals take advantage of this?
Sure. So its basic core premium financing of life insurances. It's simply the combination of two things. It's a life insurance policy and a bank loan, which is used to fund it. And it's as simple as that. It becomes more complex when you start thinking about how does that impact clients' planning? What are assumptions for long-term values? How do you service interest or pay off a loan? All of that goes into I guess, the details, the complexities of it. But at its basic and absolute core, it's as simple as an asset of permanent life insurance and a bank loan to fund it. The people who are typically using it, they fall into a couple categories. I believe the best cases for this are folks who have gone through a pretty comprehensive planning process. These are typically business owners or families with large illiquid assets or tax inefficient positions. What I mean is that these are families or individuals or corporations that have significant value. And they're looking to plan for how to transfer those values to either the next generation, the next owner, keep them in the family, or just insulate against the risk of premature death. And their biggest obstacle often is liquidity. And the liquidity is needed for a number of things. It could be to fund a buyout. It could be to pay a tax bill. It could be to spread the wealth amongst individuals where the family is illiquid, and so they're trying to create liquidity to pay to invest or seed capital to other people. So that's why they'd use life insurance. And where financing comes in is just the efficiency of using borrowed money. Generally, what it comes down to are families that have the ability to earn on their capital. They deploy their capital. They place it where it's going to earn the best. Life insurance isn't a place where people get rich. It's a place where there's safety, there's security, there's a backup plan. It's modest growth over time, but they're going to deploy their capital where they're going to earn the best return on it. And life insurance typically isn't that for families who have built significant wealth. And the other piece is for efficiency of gifting. The kinds of contracts we're looking at, kind of our sweet spot is clients that are typically 30 to 300 million net worth. They're primarily illiquid. They know how to make money on their money. And part of their transfer strategy is what are the best assets to give to trusts to move assets out of their estate. And often cash is not an efficient asset because there's no way to value cash other than the face value. There's no discussion. There's no negotiating on what the value is or trying to use some market efficiencies. Cash is cash. A dollar is a dollar. And so if someone's used all of their lifetime exemptions or if someone's trying to figure out the right things to pass, it's not usually cash. So we get a loan to a trust to pay for life insurance. The trust owns the insurance and it funds the plan. That's in a long roundabout saying it. The clients that are using this have identified a planning strategy to move assets. They've identified life insurance as a tool to fund that plan. And they realize the most efficient way to fund the life insurance is using borrowed dollars. That's what it comes down to.
Wow. So then if somebody has a finance policy already, let's say they bought a policy, an IUL or whole life or whatever, and they've been financing it and now interest rates have changed, what's important for them to be paying attention to right now?
That's a great question. So over the last year, that's been the majority of the work we've done because interest rates went up to the point where a lot of people were either they were skeptical about jumping into it. They didn't want to leverage up in a higher interest rate environment than they had seen previously. So a lot of our work was spent talking with families and individuals who had purchased policies and financed them, and now their projections were much different than they were when they bought them. And our number one value in our company is transparency. That's number one. And so when we're hired, it's to shine a light on the whole strategy, what's going on. And so what we do is we look at the two elements. Again, there's a loan and there's life insurance. And what we do is we run a myriad of options and assumptions to see how those two work together, given the current interest rate market, the current lending environment. What does that look like from cash flow, from interest rates? We look at policy performance from guarantees all the way up to their current high point. And we look at how do those things interact with each other. We have the clients or the advisor run multiple funding strategies, because what we want to know is, what are the options? What does it look like to the family if they get out of the plan totally? What's the easiest way to get out if all of a sudden they feel they're over levered, they're overcommitted, they need to right size their insurance, and exiting this strategy is part of it. We look at what are the effects of exiting early. That could be from loss of collateral. That could be from writing a check to pay off the bank. What does that look like? Another option we look at is, what if we stop funding a policy? So if the policy is no longer funded, no additional loans are picked up, what does that turn the future into? Typically, if it's in the early years, whole life is hard to stop funding early. You have to take the policy reduced paid up. If it's an IUL, you could skip some premiums. If it's a UL, you could skip some premiums. But the effect of that is that the cash value may not be as high as fast. You may not have properly funded a policy for it to last for perpetuity. And you may find that you need to fund it later on more. But what happens is we get to run those analysis and show them, here's what happens if you want to exit the policy or pay it off with outside assets or a loan against the contract. Here's what happens if you stop making premium payments. Here's what happens if you continue the course and what the current lending market is scheduled to look like. So future cash flow changes. And we even, for some clients, they want to know, well, I like the asset of life insurance. What if I fund more? What if I just actually borrow more now? And I like the way the policy is performing. The S&P has done great. We're capping out our performance numbers. What if I borrow more? How does that work? And we run all of those options and sit down with a client and show them how each one is projected to do. That way they can make the best choice going forward.
Wow.
Clients all do different things based on the rest of their planning. We've seen clients pay off their loans, write a check, get out of the transaction, remove the leverage, just keep the policy going, and no more funding or pay the funding out of pocket. We've seen that. We've seen clients do policy loans where if they have enough cash value to do some of the loan payoff, it's like refinancing the loan with a portion out of pocket and a portion from the carrier's loan provision. We've seen clients continue the course, pay higher interest than they were originally expecting, temper their thoughts. We've seen clients accrue interest for in-force policies that are older. Some of them have said, we've limited our cash flow or we're holding on to dry powder. I have a client out on the East Coast. He's accruing all the interest because he's hoarding cash for real estate deals, because he's on the hunt right now for things that he thinks are buying opportunities. And so you have all these different people with these different businesses that are doing different things. But my belief and why clients hire us, they want to know the truth. They want to know full transparency, all of the different scenarios they can think of and how they may look or play out with a wide range of assumptions.
Wow, that's incredible. John, this is so insightful and amazing. I appreciate you taking time away from your schedule to help enlighten us and share what's going on with this landscape. If people have more questions or they want to reach out to you because they think they have either for agents that have a client that they need help with, or for clients themselves who are watching and go, you know what, that might be more my route, how do they get a hold of you?
Sure. I would say anybody who's following this, Daniel, should just email me directly. My email address is jreed@financed.life. It's JREED at FINANCED.LIFE. And I would just ask just share what's going on. We see enough deals, we see enough transactions that we can typically point people in the right direction pretty quickly.
Yeah, you've been great about that with me over the years, and I think we got some great stuff working on I'm excited about. So John, thanks so much for joining us. If you guys like this interview and you want a little bit more, John and I did a video a while back where we broke down a little bit of a finance case together. So if you want that, check that out over here. That'll be somewhere in this area, and then we'll get back to you soon. So thanks so much for watching.